Hello, John Momartz, along with Bob Key. Wanted to take a couple of minutes and give you all a little update on how we're seeing the markets and what we're doing with your portfolios. Bob, you want to start?
Yeah, we've certainly been going through some interesting times, haven't we? John, you and I have discussed a lot of the complexity of investing today and everything else, but one of the things that we've talked about a lot over time, for all the complexity, sometimes the most basic thing in investing you need to do right, which is keep people invested, unless, as we said, unless we identify that a recession is imminent and we must run for the safety of cash. The terminology safety of cash is an oxymoron, because if you've been sitting in cash, which was very easy to do, we were one of the very few people not calling for a recession and calling for not only growth but inflation to moderate back down towards the Fed's 2% level. Um, for all those that are in cash, they missed out on, over the last 18 months or so, missed out on a 56% return in stocks. And that's, we discussed what sectors to be in, or large cap, small cap, growth versus value, et cetera. Really, what overwhelms all of that is if you're sitting in cash versus being in the stock market. So stocks are definitely in what we would call a more of a melt up phase at this point. For the last 4 years, we've been grinding, trying to, have bear markets and lots of threats of bear markets and sharp stock sell-offs. But yeah, the recession that was much promised never came, and stocks have rallied considerably. One of the we were also, you and I, John, were laughing about how it's in the nature of financial advisors, investment managers to sort of not let themselves be happy, or to be unhappy when people are happy. And everybody's happy right now because everyone's making money, which obviously brings us concerns, because when everybody's doing well, there seems to be a lack of fear in the market, or worse yet, an exuberance in the market. We can see that investor sentiment is very high. Now, the challenge with investor sentiment, unlike investor pessimism does a pretty good job of timing market bottoms when pessimism gets extreme. Uh, Investor exuberance, on the other hand, can extend on for months or even years at a time, and markets could continue to go up and get overvalued. So we're acknowledging that markets are a little bit frothy right now, priced for perfection, we would say. The chances of corrections, not bear markets, but pullbacks along this way have definitely increased. But as of now, we have an economy that is growing. We have earnings that are growing. We have inflation that is moderating, and we're not going to run for the safety of cash. So to that point, we look at forward earnings. We have forward earnings coming in at almost 12% year over year. When you buy a stock, what you're buying is that company's earnings, right? When you buy a stock, you're buying a small percentage of that company, so you get that small percentage of their earnings. If earnings are growing at 12% and everything else stays normal, we would expect the stock to increase by 12%. And that's what earnings are growing at. So, that's probably a reasonable expectation for stocks going forward. We see the GDP also, Q1, 2.9%. That, it's nothing wrong with that. No, excuse me, nothing wrong with that number. We're definitely not in a recession. The economy is growing, and corporate earnings are continuing to show impressive year-over-year gains. And then what probably is most shocking of all to the consensus forecast is how inflation has come back down. Headline CPI is at 3%. We had said, over a year ago, or a year and a half ago, when it was crazy high at 9%, that we expected by the end of this year for it to start approaching 2%. And we still see that. And that all gets back to how we talked about that we don't have the old school cost push inflation where labor markets push inflation higher. What we have are these enormous productivity gains. So as labor costs increase, again, that's the biggest component of cost is labor. We're either able to make workers more productive through technology or simply replace them with technology. So that's why we're seeing the Fed for almost 2 decades has been worried about, been having trouble getting inflation high enough. We finally put a ridiculous amount of stimulus in there and got a little sugar high, but sure enough, we're returning to this 2% inflation rate. Lastly, it's always important to look at where valuation stands, and You could definitely say that valuation is a bit high on the larger cap side, in particular that light purple, I'll call it, violet maybe. You can see that's the mega cap 8. Those are the Amazons, Apples, Facebooks, etc. They have a very high multiple, and that's pulling up all of large caps multiples. But if we go down, we look at small and mid cap, they're actually very reasonable, right around that 15% number, 15 times earnings number. And even though the mega caps are as high as they are, you could argue that they're justified because their earnings growth is so tremendous that they justify those high levels. So valuation's not cheap. It may even be slightly overextended in the large cap space, but we're certainly not at ridiculous levels of valuation right now.
Thank you, Bob. And as with that, I know we threw a lot of statistics at all of you. If you have any questions, please give us a call, but we are paying attention to the markets and managing your portfolios for your objectives. So give us a call if you have any questions. Hope you all have a great summer and take care. Thank
Thank
you.
you.